Hi, everyone. Hopefully you guys can hear me and see me. We will give others just a couple minutes and then we'll get started. Okay, well, let's get going. Everyone's on mute, but I'm hopeful everybody can hear me and see me. Raise your hand or send me a chat if you can't. But I'm excited to kind of talk with you guys today about some changes that are happening with the retirement plan. Our office, Phillips Financial, we're super excited and we want to make this as easy as possible for you guys. Thanks, Garrett. Thanks for letting me know. Never want to be talking to myself in any of these meetings. So just a little kind of reminder on who we are at Phillips Financial, because we have been the advisors on your 401k for many years. But there's a team of 4 of us. So Chad Birch and myself, again, I'm Erin. We are the 2 advisors on the retirement plan. And then we also have a few customer service individuals between Christine Straub and Marissa Meadows. So really between the 4 of us, we can cover any of your questions as it relates to the plan. Whether it's advice and guidance, on are you investing appropriately? Are you, oh, Nikki, I'm just sorry reading the chats just to make sure I'm not missing anything. But we want to make sure you're invested appropriately and offer our services for that. If you're unclear on if you're maximizing the benefits of the plan and how to do so, if you're locked out of your account, you need quarterly statements, you need help with understanding your investment risk and volatility, and are you invested appropriately? All of those things are things that our team can cover for you. So it's always good to put some faces along with the names to know who your individuals are. So please don't ever hesitate to reach out to us if you have any questions. But the big kind of takeaway from today is I want to talk with you about a fairly big change that's happening with your 401k. Sounds like you guys are going through all kinds of changes right now with maybe a system change. Sounds like there's some things happening in the office as well with maybe new paint or kind of maybe some new decor. And so we're going to throw in a 401k change into all of this at you. But we're going to make this as easy as possible with really very little action, if any, required from any of you. So I always do like to do these meetings in person because I like to see faces. I always want to ask the question, how many of you are even familiar with Ascensus or have used the Ascensus website or the mobile app? And since I can't see you, you guys can keep those answers to yourselves. But currently, Ascensus is what we call your record keeper. So that's the website that you go to. We kind of partner with the Ascensus, so we work together, but we're kind of limited to their system limitations. And so we can't make changes on your behalf through the Ascensus website, but we can kind of help navigate and help you work through changes. But that is what we're essentially moving away from or changing here over the next couple months. We're moving away from Ascensus as that website record-keeping platform for you, and we're moving to a company called Epic Retirement Plan Services. And so Epic is, it's not a local company. I know there's an Epic in Fort Wayne, very different companies, but Epic RPS is a record-keeping company in Rochester, New York. And we've had a ton of great experience with them. They're very service-oriented, really great website, robust systems, and we're super happy with them. I think you guys will really feel a difference between utilizing the Epic resources over the Ascensus resources. So this is all happening kind of starting in the next couple weeks, but essentially effective around the end of September, September 25th, is when we are expecting your plan to be live with Epic. And so once that plan is live, you're going to have a whole new website to go to. It's an enhanced participant experience, a new mobile app, a lot of kind of different things that you can do and tools that you'll have access to. Through that process, as far as changes that we're making, when we think about the investments in your plan, you as an individual have the flexibility to choose a portfolio, a model portfolio. There's 6 different portfolios, and that's a blend of funds managed by Phillips, by our company. You have the flexibility to create your own custom allocation. So maybe you don't have one of those models, but you're just picking kind of standalone funds. And that is all coming over with Epic. So that is not changing. So you will still have the exact same investments in the new platform, and your current and your future investment elections will be mapped. So what that means is whatever your allocation is today will be the same allocation once everything's up and running and live with Epic. The one change we are making is just an extra option. No one will be opted into it or mapped into it. It would be something you would have to elect kind of on your own at some point in time. But we are adding in target date portfolios. So those are age-based, time-based investment options. And we're utilizing Vanguard, which is one of the largest investment management companies, to kind of host or house those target date portfolios. So I'll explain a little bit more about that as we move on in the presentation. Other big things that will kind of be changing with this migration and this update is everything is going to be pushed online on the website or the mobile app and paperless processes. And so your deferral modifications, so the money that you're contributing into your 401k, if you wanted to change that, increase your contribution, decrease your contribution, change the sourcing, maybe you're contributing a pre-tax contribution and you'd prefer to do a Roth after-tax contribution. You'll have the flexibility to do that as often as you'd like through the website, through the mobile app. We can also make that change for you. So if you didn't want to mess around with the website and you just knew I need to bump my deferral up from 5 to 6%, you can call us and we can take that action for you. And when that is done online, that kind of feeds the data to your HR team so that they know to make those payroll changes. Any sort of distribution requests will also be done online. So if you're an individual that qualifies for a distribution in the plan, whether it's while you're working or whether it's once you're retired or no longer with MDS, you'll have the flexibility to kind of request a distribution online, and we can also help with that. Your quarterly statements will also all be defaulted to e-statements. And most of you are probably already getting that with the census because that was a push the census did a couple years back. With Epic, you will get an email first couple business days of each quarter reminding you that there's a quarterly statement available. You could go out, download that quarterly statement, print it off for your records, or save it to your files. But you don't ever have to get that quarterly statement. Your plan, just as it has been in the past, will continue to be what we call daily valued. So every day your balance is being updated. So if you want to kind of see what's going on in your account, you can always check in on the app or the website and see where your current balance is at. It's always reflective of the prior business day. So when you look today, you're not seeing real time today, you're seeing yesterday's balance. And that's true of a census, true of Epic, that's true of all 401k plans. Another kind of big change that you'll see in the website, Epic does a really great job of trying to collect beneficiary information. And so in your industry, I'm sure you guys are super familiar with beneficiary, what that term means, how important that is. But we want to make sure we're collecting, updated beneficiary information. And so you may have filled out, or you should have filled out, a paper form at some point in time designating a beneficiary. The paper forms don't get kind of transferred into the system, but your paper forms continue to be valid. So if you do absolutely nothing, whatever you have in your paper form for your beneficiary remains your beneficiary. However, the system will kind of nudge you when you're logging in to update or add a beneficiary if you don't have one on file. And so you can go onto the website, go onto the mobile app, add your beneficiary, add your contingent beneficiary, make changes or modifications at any point in time, and kind of the chain of command of what would happen if something were to happen in the event of your death. First, we review who is the beneficiary listed on the website. That trumps a paper form if there's also a paper form. If there is nothing on the website, then we look at the paper form and that is what is used. So that will be a change that we're going to try to push to collect beneficiary information on the website going forward. And then kind of last, a really unique tool I think that's offered by Epic is their retirement readiness calculator. You guys may have seen these, in other forums. Ascensus has one as well, so you may have played with the Ascensus calculator on their website. But I think Epic does a really great job of having a really intuitive, kind of no nonsense, really easy to use retirement readiness calculator. That's just an interactive tool to kind of give you a projected goal of the retirement income that you'll likely need. It projects not only from a monthly standpoint, but from a total standpoint, kind of a total balance. And then it gives you that flexibility to play around with different edits to see, well, what could have a big impact on, pushing yourself to be more retirement ready on track if you're not there. You can edit your deferral rate and see, well, if I bump my deferral up, what kind of impact does that have versus maybe changing your time horizon and your retirement age to see how that impacts. And so I think this is such an important tool because whether we like what we see or not, we really all should have a really good handle of how are we doing? Are we kind of on track? Are we significantly behind or are we significantly ahead? And I think everyone can agree that, you don't want to be shocked too close to retirement and not realize that you weren't nearly where you should have been. So this kind of helps set those realistic expectations to identify what you should be doing to promote kind of healthy retirement readiness. The advisors for your plan. So again, you've got Chad Birch, you've got myself. We will continue to be your resource. So that's not changing. Whether you've used us in the past or not, we are always happy to help, provide that guidance, look at your account, answer any of the questions that you have. So please continue to use us. I don't have in my PowerPoint kind of the biggie of what's not changing, but I think this is really important to make mention that your employer contribution, so the 3% that MDS and AGA, depending on what side you're on, puts in on employees' behalf. So the 3% we call a safe harbor contribution. The 2% profit sharing contribution, those are not changing. So that continues. As a reminder, the 3%, everybody gets it no matter what. That 2% profit sharing, currently everybody gets that. That's eligible as well. But that's what we call discretionary. So the profit sharing could change through the years. Historically, it hasn't. But because it's a discretionary contribution, the employer does have that flexibility to modify it depending on, good years, bad years, and whatnot. So there are no plans to make any modifications to that. So business as usual when it comes to those employer contributions that are going in. Kind of just working through the time frame, the mechanisms of how this change occurs. I think it's important to note that there's nothing that you have to do. So you do not have to re-enroll or kind of re-up your contribution for everything to continue. But while we're planning this conversion, and again, conversion is essentially moving away from one record-keeping system to another, there is a period of time that's called a blackout. And a blackout is up to a 30-day window span of time where your account cannot be modified as all the records need to be settled and kind of are getting packaged up to be moved from one record-keeping relationship to another. So as we prepare for this, and you should have already received a notice, your blackout will begin on August 21st. So as of August 21st, if you're wanting to increase or decrease your contribution, if you're wanting to try to take a distribution, if you're wanting to transfer or rebalance or kind of reallocate your investment account, those will be prohibited during this blackout. It does not mean that your money's not invested. It doesn't mean it's not changing, for the good and bad of the market. And it doesn't mean you won't see that. It just means you can't do anything during that window of time. And so that will start August 21st. Shortly after the blackout, probably a little bit closer to end of August, early September, the funds from your existing account will be liquidated and wired over to Charles Schwab, who's the bank behind the scenes that will reinvest the money. And so the money gets reinvested from a plan level, which what that means is we know the records of how many units the plan owns of every different fund. So it immediately gets invested. And then it takes time for Epic to kind of work through everybody's individual accounts to apply everybody's different units and values and investments internally. So again, the blackout could last up to 30 days at most, but during that time frame, you essentially are invested the entire time, with the exception of a 1 to 2 business day window when that wire transfer happens. We believe then the blackout will be lifted around September 25th. That's kind of the expected go live date. And at that point, you will be notified that that blackout has been lifted. You'll have access to a whole different website platform. You can have download the mobile app. Your only to do then at that time would be to register yourself for your new account. So your old login, your old password with the census will not carry forward. You will have to create a new login and a new password, and we will provide kind of the default credentials to give you access. So that's what's happening. And then within that conversion, your money is being mapped from same investment to same investment. So again, if you had money in the moderate aggressive portfolio, the model, it's going to be in the exact same allocation once everything's live. If you had your money invested in kind of specific core funds, maybe you were in the Vanguard 500 index fund, or maybe you're in the international fund. Those funds, again, will continue and your money will be mapped from same to same. So there are no changes to your investments. And again, we'll talk about the added investments, those target date, here in just a few minutes, but no one will be mapped into any of those new funds. Before I continue, I'll just pause, check in, make sure there aren't any questions about the conversion and the time frame at this point. Okay, so while we're here, I always think it's great as we kind of work through some of these plan changes, just to provide a few kind of best practice reminders, tidbits of guidance. And I think through kind of the common questions that we often get from our employees, our participants. Big one is, well, how much do I need to have to retire? What do I need to have? What's that nest egg look like? And it used to be investment professionals would kind of blanket statement $1 million. Everybody needs $1 million. And that's just really inaccurate, because it's all about the needs based on our income and our lifestyle and what we're living off of. So we really have to look at appropriate levels of saving against your income, and then what that equates to as far as balances based on your income over different kind of age milestones. So I love this chart because I think it's really a helpful visual to kind of identify the ultimate goal for us to be truly retirement ready. We want to try to replace between 70 to 80% of our pre-retirement income. So in other words, we don't need 100% of what we're accustomed to earning to live off of in retirement, but we need to replace that by about 70 to 80%. And the ultimate goal is to have 10 times our annual salary saved at our kind of normal retirement age. So we can break that out into different kind of milestone amounts. By the time you're age 30, you really ideally want to have 1 times your annual salary saved at that stage of your early career. By the time you're 40, ideally you want to have 3 times your annual salary saved. By the time you're 50, you want 6 times. By the time you're 60, you want 8 times. And then again, the goal by the time you're normal retirement age, which is age 67 for really most of us, you want 10 times your annual salary saved. So the numbers that you see over to the right may or may not be relative to you at all, that's just an example of a $50,000 annual salary. So that's kind of why that $1 million blanket doesn't work for everyone, because if we are never accustomed to earning more than a certain level, then our needs are going to be different than those that maybe have been earning a higher amount. So it's more important to kind of break it down in multiples of your salary. And in a perfect world, which I know we don't live in a perfect world, but ideally for us to really be consistently on track to kind of hit those numbers, we really need to be striving to be saving between 10 and 15% of our annual kind of holistic income per year. And so that's kind of where, if you're looking at that chart and if you're like, whoa, I am definitely not on track, or I'm not as on track as I thought I was, you need to identify, well, how much have you been contributing? And has that changed through the years? And are there ways that you can push yourself? And so the great thing about the group services plan is everybody gets that 5% no matter what. And it's not a match. So you're not incentivized to put anything in to get that free 5%. But I know, I hope you know, 5% is typically not enough for us to be set for retirement. So you've got to put some of your own money in. You've got to take some action. At a starting point, if you could get yourself to a 5% contribution, your 5 plus MDS or AGA's 5%, that's 10%. That kind of gets you to that bottom window of the annual savings you should be setting aside per year. And if you're an individual that's really behind, that 5% might not be enough. You know, you might need to push yourself closer to a 10% threshold so that your 10 plus the employer 5 gets you at that 15% window. So it's definitely not a one size fits all situation. I'm happy to talk through any of your personal concerns or questions if you're looking at this chart and you're just not seeing kind of where you fit on this. But that would be the best guidance we can provide. Is you're trying to replace your income. The ultimate goal is 10 times your annual salary saved by the time your retirement age. Eyeball where you're at, and if you're not where you want to be or wish to be, think about, are there ways that you can encourage yourself to bump up your contribution, even if you stair step it kind of slowly over time. Other Okay, I think we're back. I think I was talking to myself for a little bit and I think I lost a couple of you. So hopefully everybody can still hear me or see me. And I'm not sure where I lost you guys at, but I'm going to kind of continue on. Other things I think it's really important for you guys to understand is that your plan allows traditional versus Roth savings options, and that's not a change. That's been an option in your plan for a while now. And so just as a reminder of how that works and what that means, your traditional contribution essentially allows you to contribute pre-tax dollars, dollars before they have been taxed. And then those dollars get allocated in your account and they grow on a tax deferred basis. So you're not paying income taxes year over year on the growth. You're deferring all of that until later on when you take that distribution at retirement age or later on. So that is kind of the traditional pre-tax route. You also have the flexibility in this plan to do the Roth after tax route. And so that is where you pay your taxes upfront. So you are making after-tax contributions to your 401k, and then those dollars grow on a tax-free basis. So now you pay your taxes up front. The end result is when you cash that money out later on in retirement, no income taxes are owed on the entire amount, which means you avoided the taxation on the growth since you only pay taxes on your principal deposit. To truly benefit from the tax-free growth, you have to meet two requirements. You have to take a qualified distribution, which means your very first Roth deposit has to be seasoned for 5 years, so it has to be 5 years old. And then you also have to be age 59 and a half or older. And that's true of your pre-tax dollars as well. There's always penalties if you cash out your account, whether it's pre-tax or whether it's Roth, prior to the age of 59 and a half. So you have flexibility in this plan to allow for pre-tax contributions or the traditional route, Roth or after-tax contributions, or any combination of the two, whether it's a dollar amount, percentage. You can break that into any differential between pre-tax and Roth. And when we think about who those kind of traditionally work for better than others, we can kind of stereotype different buckets of individuals. And when I think about who a traditional pre-tax deferral is ideal for, if you feel like you're behind in saving, a pre-tax contribution is easier to save today because you get the immediate tax deduction, the immediate tax break. So it's easier for the now, but you may not benefit as much long term because you do have to pay the taxes later on your entire amount. So then you have to look at your tax bracket, and that's a hard one because it's unknown. We may not know what our tax bracket is today versus what we think it's going to be 10 years, 20 years, 30 years from now. But if you expected to be in a lower tax bracket later on in retirement, a pre-tax or traditional contribution would make more sense than Roth. If you're the opposite, if you're an individual that feels like my tax rates are probably just going to go up or they're going to be higher in my retirement, phase, that's when Roth might be more ideal. Or the younger you are, the longer you have to save, the more ideal Roth can work, because the more time we have for market appreciation, the greater the benefit that Roth can have for you. So again, you've got all the flexibility in the world in this plan on how you split that. And your flexibility between pre-tax or traditional and Roth after tax is really just towards your contributions. So the employer contribution that Group Services puts in, the 5% contribution, that does not have flexibility to go in as a Roth contribution. That goes in as a pre-tax contribution. Your employer takes that deduction. Oh, was there a question?
Now, raise your hand.
Okay, moving on. Let's talk a little bit about the investment piece. And hopefully some of you have seen this before. This has been an education material that we've had. If you've gone through an enrollment meeting with us, you've probably seen this before. But when you think about ways to invest and how you should invest, there's so many different routes, so much different guidance and advice. But the most important takeaway on how you should invest is to understand the importance of diversification. And I'm sure you guys have all heard the term, don't put your eggs in one basket. That's true of the market as well. And so when we think about the benefits of diversifying, we know having a little bit in all the major categories of the market, academically, the studies are out there that validate this. Those studies show that that has the greatest impact on your kind of long-term investment return. And this chart kind of helps represent that as a visual standpoint. It shows a 15-year span of time, year over year. You can see different colors scattered throughout. Each one of those colors represents a different category to invest in. And in any given year, there's winners and there's losers, or there's funds that overperform others and there's funds that underperform others. And no one can accurately predict year over year who's going to be the winner and who's going to be the loser. And so what we believe in, what again is so important when it comes to your investments, is making sure you have a little bit in all of those categories by diversifying, because what we know is winners rotate. And when you diversify and you have a little bit of everything, you're always going to have a winning category or a fund category that's over or outperforming others. And that's important. That helps build and boost your account. But you're always going to have a fund that's underperforming. And sometimes that doesn't feel great, because when we're looking at our balance and we're seeing, volatility and reductions, we don't want to have the funds that are underperformers. But that always provides a buying opportunity for you. And if you think about how we kind of treat the market versus how we treat buying other kind of common goods. When the market is strong and we're seeing, rates of return and positives and our economy feels strong and the forums are fairly positive, we get excited about investing. When the opposite happens and there's market volatility or uncertainty or whether it's wars or economic uncertainty or pandemics or things that just kind of cause a bit of kind of knee-jerk reactions from an emotional standpoint, and the market suffers that volatility, we get a little bit more concerned and we don't get super excited about investing. But the reality is, when we buy everything else, whether it's groceries or common goods or gasoline, we like to buy things on sale at a discount, at a reduced price. And so when you kind of force a discipline of asset allocation, you always have a buying opportunity, which is extremely important when it comes to your 401k, where every other week you've got money going into the market. And so that diversification kind of helps minimize your risk and maximize your long-term returns. There's a couple ways that's done in this plan. And so as a reminder, you already have and will continue to have 6 model portfolios where those investments are kind of constructed on your behalf. At one point in time when you joined the plan, you should have taken an investor questionnaire, and that would kind of help look at your age, your time horizon, your kind of responsiveness to volatility or market risk. And that packages that all together and kind of plots you into one of these different models. The balance model would be the most conservative option, which has 50% of it in equities or stocks, and then the other 50% in fixed income or bonds. We could go to the other extreme. The most aggressive allocation is 100% equities, 0% fixed income or bonds. And then there's those 4 in between. And then we kind of take on the work of choosing those allocations, managing that allocation, and managing those model portfolios. And then what these do, they stay at that same level of risk forever and ever and ever. So if you joined at a really aggressive investment option and 10 years go by, you're still just as aggressive 10 years, in the future as what you were when you started, because those models are more of a risk-based allocation. The new options that will be added in late September to your platform with Epic are those Vanguard Target Retirement Funds or Target Date Retirement Funds. And so these are now age-based options. So they work very similarly to those model portfolios where they are kind of a disciplined construction of diversified investments. But now what these portfolios have is a glide path of risk associated with the type of portfolio that you're invested in. And so each one of these has a number kind of correlated with it. And that number is meant to correlate with the year closest to your normal retirement age. So if you were planning to retire around the year, 2038 or 2042, you likely would be in that Vanguard Retirement 2040 portfolio. And that kind of allocates you in a stereotypical allocation meant for somebody who's got about 15 years until retirement. And so it starts out more aggressive and then kind of has a glide path to get more and more conservative as you get closer to the year 2040. Now, the 2070 portfolio is going to start out much more aggressive than the 2040 because the 2070 has a much longer runway. So you can kind of see the glide path where the more time you have, so the younger you are, the more international and domestic equities that you have. That's kind of the greenish turquoise-ish color. But then as you age, the more bonds or cash you get, which is kind of between the mustard yellow and the gray. So you get increasingly more and more conservative. So the target date are more of a set it, forget it. I'm not going to wake up and be far too aggressive based on what my age allows. Whereas those model portfolios give you the flexibility to control your risk, in which your age may say one thing, but your investment preference may go against your age. You might be more aggressive or more conservative than based on what your age suggests. So going forward, when everything is live with Epic, you'll have kind of the flexibility on both sides to stick with a model portfolio and allow the risk to be kind of the driving factor to the allocation. You could move into a target date and allow your age and your time to be kind of that driving factor as far as how it's allocated. Or you can always choose a custom allocation, go outside either one of those and create your own allocation with the funds that are offered within the plan. So this is really the only investment change that is coming. And so the last thing that I wanted to end with, I'd love to do just a quick demo of the Epic site, because I'm really excited about this site for you guys. I think you'll love it. I think you'll find it very easy, and the mobile app very user-friendly. I've got some QR codes there for you to scan if you wanted to download the mobile app just to have it. It will not work for you yet because Epic does not have your data. You will not be able to access your account until you get that go live notification, which will happen in kind of the latter part of September. So if you're an Apple or an iPhone user, that's kind of the top QR code. If you're an Android or Samsung user, that's kind of the bottom QR code. And then just to kind of show you a couple of the key features from the Epic website. When you first log into your account, you'll see your total balance, and you may see a difference in total balance versus vested balance. Vested balance would just be the ownership you have in the total dollars in your account. And so as a reminder, money you put in is always fully vested. The 3% that Group Services puts in is always fully vested. It's that 2% profit sharing that's discretionary that goes on a vesting schedule. So if you haven't been employed for 6 full years, you may not be fully vested, which is why you might see kind of a differential between what you have and what you own. And of course, if you've been there for 6 or more years, they should be one and the same. On kind of the main homepage dashboard, you're always going to see the really important features, your total balance, your vested balance, the investments that you have. So kind of the pie chart portfolio. Do you have large cap, small cap, mid cap? You can kind of see that breakdown in the percentages. You'll have a My Retirement Goal. This is that retirement readiness calculator. And so I'll circle back to this and kind of end with this because I think this is a really powerful tool. On the right side, here's where you can change your contributions. And so if you wanted to increase or decrease or go from Roth to pre-tax, you can kind of do that from the home page. You can just click on that caret. That opens it up for you to have the flexibility to do a percentage between pre-tax or Roth. You could do a dollar amount too if you'd rather do a dollar amount. The system also has an auto escalation or auto increase as an option, and you do not have to use it, so you can certainly make sure that's toggled to the off, the left side. But where that auto increase could be effective for some, if you knew, you were at a 5% total contribution, but your goal was to get to 10%. That's what you want to do. But, as life goes on, we get busy, we forget to kind of push ourselves to make these changes. You could set that so that every year you have that go up, 1%, maybe by the end of every year, and you want that to go up 1% until you get to a 10% contribution. So you start out at 5, but it's going to force you to get to 10% over a 5-year span of time as you bump that up 1% each year. So you've got that flexibility if you want to play around with that. If you modify your deferral, you just want to make sure you kind of submit that, click on the continue. You'll get a summary of what it looks like, your old value and your new value, and then you'll just want to submit that and get a confirmation. And once you submit that, again, that feeds that to your HR team. They'll make those changes within a couple pay cycles, depending on the timing of when you did this. If we go back to that home screen, that home dashboard, I really like this middle section, but I think it's going to take some time for this to provide more value to you all, because this will show you kind of the life to date from the time that your assets moved over to the Epic platform. It will show you your kind of cumulative rate of return. And the reason I think this is so important is sometimes we get so caught up in the quarter by quarter, the good and the bad and the ugly, that we often forget that sometimes when we see a loss in our account, it's not truly a loss. It may be a loss in a value from where we were at a prior reporting period. And so what I mean by that, we could have had a really fantastic 2025, and you had double-digit rates of return. And then we had first quarter of 2026 where we had losses. Now, what really happened is you lost some value that you earned in 2025, but you really didn't lose your actual principal deposits. It's just you lost some of those gains. So this will kind of ongoing put in perspective, where are you at as far as, are you truly up? Are you truly down? And how good or how bad does that look? And I wish we could pull in all the data from a census so that this provided more of a historical perspective from even before the plan moves, but a census does not provide that data. So this will kind of start afresh from essentially late August and start tracking that for you. And then below that, you'll see your positions. So you'll see the different funds that you have or the models. If you're allocated in a model, you can toggle to look at the sourcing. So between what you put in from an employee standpoint as a pre-tax contribution or a Roth contribution, you can see kind of the total balance. And then you can also see profit sharing, the safe harbor, what your employer has put in on your behalf. So all that is what you can see kind of on that home page. If we go to those kind of top drop downs and click on them, if you go to account information, here's where you'll be able to access your quarterly statements once they get loaded. Or you'll be able to run kind of a custom quarterly statement over a different period of time. You can look at your transaction history if you want to see the timing of when your contributions have been allocated to your account, or what was the employer contribution that recently went in. You can kind of see all of that. If you go to transactions, here's where you can actually modify, make changes, make requests. So you can change your deferral from here, which you also could do that from that home page. That deferral section is one and the same as kind of the contribution section on the home page. So it's just a different place to do it. You can change your investments. So that's your new dollars, your future dollars. You could transfer existing dollars. You can rebalance depending on what your plan permits in the form of distributions. And again, this is a demo site, so this shows everything. Your plan will only show what's available to you, but that's where you could request distributions if you are eligible to take one. If I go over to the personal section, here's where you would go to update your beneficiary. So if you want to add a beneficiary, add a contingent beneficiary, or make some changes, you can do that there. Also from the personal section, you can change some of your preferences. You can change your contact information. If there's a new cell phone or a new email address that you want to put on file, you always have that flexibility to do that on your own. There's other tools, but just for the sake of time, I want to go back to the home page and spend just a few minutes walking through this My Retirement Goal. When you initially get registered and log into your account, you are not going to see a projected percentage and a goal. It's going to ask you to set that up. And when you set that up, you will have a section to kind of edit all the different prompts that go in. So your contribution rate should be built in because the system will know what you're contributing, but the system doesn't know your income. So we don't know what you're contributing against or what you're trying to replace. So you'll want to build in your income. There will be some assumptions on retirement age, life expectancy, percent of salary needed, that income replacement ratio, rates of return, but you can change all this. So if you think you're retiring at 67 and you know what longevity is in your family history and you want to change your life expectancy, if you think that your rate of return is going to be more aggressive while you're working, which is typical, versus when you're in retirement, you can modify that. Most individuals are kind of instructed to take on the risk and be more aggressive while you're working. And once you're in retirement, you want to go a little bit more into preservation mode. So you shouldn't expect to earn as much because you shouldn't be as aggressive. You can factor in, cost of living adjustments or salary growth rates, inflation, Social Security can be included or excluded. So it will automatically include a Social Security estimate based on your income and your age. But if you don't want the auto estimate, you can kind of toggle and either make that, a 0 if you just don't want Social Security factored into this at all, or you can look at your Social Security statement and kind of build in something that's a little bit more accurate. You can build in other accounts. If you have an IRA, an old 401k, a Roth IRA, a spousal account that you want to build in, you have all the flexibility to do this. And so then when you put all those prompts in there, you're going to get a couple pieces of key information right in the middle. The system's going to say, you know what, based on your income and your savings levels and what you have and kind of what we're projecting, if we play it forward, you're on track to need a certain goal. So this is what you need to kind of maintain that retirement readiness status. But based on what you're doing, here's what you're projected to have. So you're going to see, you know, a heads up or a caution or a good job, depending on where you are to your goal. And then that furthermore gets broken down on the left into monthly income. So sometimes I think it's easier to understand what this really means when we look at it in the form of a monthly amount versus just a total gross amount, because I can often look at this and say, gosh, I don't know what $500,000 is going to do for me. But I could think through, and knowing my living expenses and needs, what's $4,300 a month going to do for me? So here you can kind of see of that monthly income you're projected to have, what comes from the 401k versus what comes from that Social Security estimate. And if you're not loving what you see, what action steps could you take to make your picture look a little bit more on track? Whether that's realistic for you or not, but I think it's important to understand if there are steps to take and what sort of impact they have. So could you bump up your contribution rate a couple points? And if you go from 11 to 12% of this example, gosh, that doesn't really move the needle a whole lot. That doesn't do much for us. So let me go back to that 11%. And what if instead of working till I was 67, I worked a couple more years? Gosh, I don't want to. But what if I worked 2 more years? And you can see that has a pretty dramatic impact. And so everybody's is going to look different, because if we have more time for this impact to shake out, your contribution rate is going to make a much bigger difference. A small change in your contribution rate over a much longer span of time can make a huge impact. If you have less time, that change to your contribution rate may not do much, but changing your retirement age and your time horizon and working a few more years in which you're saving for a few more years and shaving off a few years that you need to pull money out, that has a bigger impact as we get older and as we get more seasoned. So this just gives you that flexibility to kind of understand, where are you, what action steps could you take? Doesn't mean you'll do them, doesn't mean you have to do them, but I'd rather set realistic expectations versus having everybody kind of run blindly and just hoping for the best. So that's where I think this retirement readiness calculator kind of shines a little bit more so than others that I've seen. So that's really kind of everything that I wanted to cover in today's presentation. Again, our office is always available if you have questions, if you're not sure next steps, if you're on track, what action items maybe you should take. We're happy to help. We've got a general email, the retire@onephillips.com, up on the screen, and that goes to a queue, and that will kind of come to the 4 of us to kind of work through your questions. You can always call us as well, email or call us individually. We are happy to help. So we're really excited for the change. Epic is a company that we utilize for our 401k as well. So not only do we know this from a plan sponsor side, we know this as a participant as well. So I think you guys will be excited once everything's up and running, and just keep us posted if there's any questions that you have. So I appreciate your time. I'll open it up if there are any questions at this point. All right, hearing none and seeing none. So again, thank you guys for your time. And we'll keep you posted once everything's up and running live, and we'll get you access to the new credentials with Epic. Thank you.